Welcome everyone. Today we'll explore the advantages and disadvantages of investing in index funds versus selecting individual stocks with a focus on dividend growth investing. Exchange-traded funds, ETFs, offer diversification benefits by pooling assets, but they limit stock selection as investors relinquish control over specific stocks included in the fund. Tracking predefined indices or benchmarks. This lack of control may hinder investors from fully implementing personalized strategies, such as focusing on dividend growth stocks or targeting specific companies based on individual criteria. In contrast, investing in individual stocks allows for hands-on portfolio management, enabling investors to select companies aligned with their investment goals and conduct thorough research. While ETFs provide simplicity and broad market exposure, individual stock selection offers greater customization, albeit requiring more time and expertise. Ultimately, the choice between ETFs and individual stocks depends on investors' risk tolerance, investment objectives, and preferences for portfolio management. ETFs often hold weaker stocks and may include companies in decline or deemed undesirable by active investors. This is because ETFs typically track predefined indices or benchmarks, which may contain a broad range of stocks, including those that may not meet the stringent criteria of active investors. As a result, ETF investors may inadvertently be exposed to companies with weaker financial performance, lower growth potential, or ethical concerns that they would typically avoid if actively managing their portfolios. Additionally, the passive nature of ETFs means they may not adjust holdings based on changing market conditions or company fundamentals, potentially leading to prolonged exposure to underperforming or declining stocks. In contrast, active investors have the flexibility to selectively invest in companies they believe have strong growth prospects, solid financials, and ethical practices, allowing them to avoid weaker stocks and potentially enhance portfolio performance. ETFs often come with hidden costs in the form of expense ratios, which represent the annual fees charged by the fund to cover operational expenses, management fees, and other administrative costs. These expenses are deducted from the fund's assets and can impact investors' returns over time. While expense ratios are disclosed in the fund's prospectus and other documentation, they can sometimes be overlooked by investors, leading to unexpected reductions in investment performance. Therefore, it is crucial for investors to thoroughly research and carefully evaluate the expense ratio of a particular ETF before making an investment decision. By doing so, investors can better understand the total cost of ownership and ensure they are selecting an ETF that aligns with their investment goals and risk tolerance. Additionally, comparing expense ratios across different ETFs can help investors identify cost-effective options that minimize fees and maximize potential returns. Overall, being mindful of expense ratios can help investors make more informed investment choices and avoid unnecessary costs that may erode their investment gains over time. ETFs can sometimes suffer from insufficient management oversight, as they typically operate with a passive investment strategy, unlike actively managed funds, which involve ongoing decision-making by portfolio managers. ETFs often rely on preset rules or algorithms to track an index or benchmark. This lack of active oversight means that ETFs may not respond promptly to changes in market conditions or company fundamentals. Instead, they may rely on lagging indicators or predetermined rebalancing schedules, which can result in missed opportunities or prolonged exposure to underperforming assets. Additionally, ETFs may lack qualitative insights that can be crucial for making informed investment decisions, such as assessing the management team, competitive advantages, or industry trends. Without active management, ETF investors may miss out on potential gains or fail to mitigate risks effectively. Therefore, Investors should carefully consider the level of management oversight when evaluating ETFs and assess whether the passive approach aligns with their investment objectives and risk tolerance. Many dividend ETFs primarily focus on metrics such as dividend yield payout ratio and dividend growth history when selecting their holdings. While these metrics are important indicators of a company's dividend-paying ability, they may not provide a comprehensive analysis of the underlying factors affecting dividend sustainability. As a result, some dividend ETFs may lack in-depth analysis of the companies they hold, potentially exposing investors to risks associated with decreasing dividends or dividend kutsu. Absolutely dividend growth investing, index investing, and ETF investing each have their merits and can be successful strategies when executed effectively. The crucial factor is aligning the chosen approach with your personal financial goals, risk tolerance, and investment preferences. Dividend growth investing appeals to those seeking steady income and long-term capital appreciation through companies with a history of increasing dividends. It requires patience and a focus on fundamental analysis to identify robust dividend-paying companies. Regardless of the chosen strategy, discipline is key. Once you've determined your approach, sticking to it through market fluctuations and staying committed to your long-term investment goals will help you navigate the ups and downs of the market successfully. Thank you for tuning in. If you enjoyed this video and want to see more informative content like this in the future, don't forget to hit the like button and subscribe to our channel. Your support means the world to us. Stay tuned for more exciting updates and valuable insights.